Hi, this is Ron Z. Let's look at some charts. Today we're going to look at the S&P 500 weekly chart. Let's explain some lines I have on here. This first line is at 2140. The next is at 2000. If you've been reading my articles on Examiner.com, you'd know that I've been talking a lot about potential resistances the S&P could find within this range. This line here is at 1565, which was approximately the highest close in 2007. This line here is the upper trend line and the current trend off crash lows, taken early in the trend. This line here is the lower trend line, again taken early in the rebound from the crash lows. This line here is the lower support line. It's taken off the crash low and the first major low after the crash in 2011. What concerns me about this chart is this break above the upper trend line that we've seen here. Breaks above the upper trend line often fall back to or below the lower trend line or the lower support line. Let's look at earlier periods to show you what I mean. This is the S&P from 2002 to 2007. Again, we have an upper trend line established early in the rebound from that crash, a lower trend line off the crash low to the first major low in the rebound from that crash, or not lower trend line, lower support line, and a lower trend line established early in the, or fairly early in that rebound. Now, what we're seeing here is the S&P rebounded into trend and maintained trend until it broke above that upper trend line. Now it stayed above that upper trend line for a long time, but during that time it had several significant pullbacks before it broke below and stayed below that line. Now what happened here is the S&P broke lower, broke below the lower support line, rebounded, retested, broke below it again, rebounded, retested, broke below it, and fell to the lower support line. Now here it found support, rebounded, retested, rebounded, and failed, rebounded, and failed again. Now that last failure led to this drop, which ended up being a bearish crash. Now had the S&P found support here, even if it fell below it and rebounded back above this upper trend line right here, it more than likely would have ended up being a bullish crash. Even though it was to crash potentials from there to there, it probably would have been a bullish crash. It probably would have come back into trend. Now let's look at an earlier time period to show you what I mean. This is the S&P from 1994 to 2000. Now the trend lines on here are taken off of the early trend change. Now as you can see, the S&P was in a bullish period here too, but it had a trend change. There's no crash to take these trend lines off of, so it was on the early part of the trend change. Now the upper support line there, the lower support line on that low there, which was fairly early in that rebound, and then this the lower trend line, this lower support line is off of this low, major low in 1998. There's no crash to take the other end of it off of, so that's the only point that we have. But these lines are all parallel. It'd be dropping a parallel line off any one of these other trends onto that low. Now we'll look at what happened here. Again, it went within trend till it broke above that upper trend line, had a significant pullback back above the upper trend line and fell. Now it broke below the lower trend line. Now this line was established off this low, so this line isn't really here yet. It rebounded back above, fell lower off of that rebound, and then rebounded bullishly you know, it was a retest of that low, bullishly back above the lower trend line. It went back up above the upper trend line, had a significant pullback, and then fell back to the lower trend line. Back above the upper trend line, significant pullback almost to the lower trend line, not quite this time. Rebound back above that upper trend line, back to the lower trend line, and from there it just bounced. It never recovered that high, but it went more or less in a sideways bounce until it failed the lower support line right here, or the lower trend line, and fell to the lower support line. Now in this rebound, it found resistance on this lower trend line, fell back again, retested, bounced back above it, and fell through it, and then it turned into resistance. That lower support line turned into resistance, and it broke lower into the crash. Now again, had it rebounded here above this line and stayed above that line, it would have been a bullish crash, much like we've seen right here. Although this was not actually to a crash level, it was only about 18%, a little under 18%. It shows what a bullish crash would do. Now I'm going to have to change time frames to show you the next time frame, but I'll show you what a bullish crash looks like, a bull market crash, in the next time frame. Now this is 1983 to 2004. There's a crash in 82 that these lines are taken off of, but this chart won't take me back that far. So you can see the upper trend line is established early in the trend here, lower trend line early in the trend off that crash. Now this line right here is not exact. In fact, it looks like it's a little bit low on this scale, but it's close. It's off of the crash low to this low right here, the first major low. It's not exact, like I said, because I can't take it off the crash low, or as close to it as I can get to that first low. Now the S&P, as you can see, stayed within trend until it broke above trend right in here. Had a significant drop, rebounded, and dropped sharply back below the support, or below the lower trend line, and established this lower support. Rebounded again, rebounded at support, retested and rebounded at support, then back above this upper, or the lower trend line. Now it didn't stay completely above that lower trend line initially, but if we drop another trend line, we'll see that it was in trend. Parallel line dropped right down. The lows stayed in trend off of that retest, and they trended higher with that lower trend line. And we're going to get that back out of there because I'll be in the way up further. Now it rebounded back above the upper trend line. Now it recovered the full crash here, and not by a whole lot, but it recovered that crash, broke above the upper trend line, significant drop, rebounded, and it made it slightly higher than it was there. Another significant drop, again made it slightly higher, and from there it broke below the lower trend line, tested the lower support line, broke through it, rebounded, retested a couple of times, and then again, but then it broke back above that lower trend line. Now these two show a bull market crashes. Now this one was about 33%. This one wasn't actually a crash. It went 19.92% from highest close to highest, or lowest close. And a crash has to be 20%, but it was so close that for all intents and purposes that was a crash and a bullish rebound out of it. Now you can see the S&P continued higher until it broke above the upper trend line again. I made that chart too small. It broke above the upper trend line again. You can't really see it on the scale. Held the lower trend line, broke slightly above or below it, and then we've seen the trend change into the higher trend that we've seen into 2000. Now I think a lot of things make me think that the S&P has entered a secular bull market. So I think if we see a large pullback to crash potentials from this, that it'll probably rebound bullishly. It'll probably, if it falls below this lower trend line, it's probably going to rebound somewhere off or below this lower trend line, and then back above and hold above that lower trend line and start trending higher again. There's a lot of reasons that I believe that. Some of them include earlier videos that I put on YouTube, my gold and treasuries, but there's a lot of reasons that I believe it could. Now this area, the research that I began in 2008 says is possible topping area. Says the most likely area that a crash could occur at would be at about 2040, right here. Now on Thursday, the intraday high was 1991. And Thursday's close is the highest close on the S&P to this point, and it was at that point it was not a little over 15% above this trend line, a little bit over 22% above the lower support line, and a little bit over 20% above this possible topping area. If you read my articles, that same research says that if we see a large drop to crash potential, it's likely to rebound somewhere near this the tops in 2000 and 2007. You know, near, could be here, could be there, or it could be right on, but it'll be, the research makes me believe it would be near that top. It could rebound off this trend line somewhere in here and be near that top, though. It doesn't mean it's going to be exactly at that top. Now, if the S&P were to fall, it probably would not go straight down. So we're probably looking, you know, more like an angle like this, and it could be maybe 11 or 12% drop to there, and maybe 15 to 18% drop to there at the angle of descent it takes, depending on the angle of descent it takes. You know, if it drops straight down, that's the only way it's going to get to be the 22 and the 15%, unless it falls to this potential top, or the potential rebound point at these tops. Now, a lot of the economic data looks good. A lot of the earnings reports look good. There's troubles in the world, but I don't see a catalyst for a large drop right now, or a crash. But what I do see is, you know, this potential resistance area, this break above the upper trend line, and also the constituent charts are showing possible topping areas. And I'm I'm going to show those charts in the next video. I'm not going to have time enough to put it on this one. It'd be too long. That's what I'm seeing to this point though. Have a great day trading. This is Ronzi.